Hey there, welcome to session 12, and we are moving into the final and most practical part of financial accounting, analyzing financial statements. We spent the entire course learning how to prepare the income statement, the balance sheet, and the statement of cash flows. Okay, now we learn how to actually use those statements to make economic decisions. Our goal in the session is to go beyond just looking at the final numbers and learn the analytical tools, primarily financial ratios, that help us assess a company's profitability, liquidity, and long-term solvency. This knowledge is vital whether you're a potential investor, a creditor, or a manager. Okay? Alright, here's our roadmap for the session on analyzing financial statements. We'll start by establishing the context of the investment decision and look at how a company's business strategy directly affects which financial ratios are most important. Next, we'll cover the analytical framework that includes defining component percentages and laying out the essential rule for ratio calculation, the need to use average balances when comparing different statements. Then we dive into the main part of the chapter, the 5 categories of analysis. Okay, we'll cover profitability, liquidity, solvency, efficiency, and market tests. Okay. Before we start calculating any ratios, we must establish the context of our analysis. Financial analysis is often described as part art and part science. A good analyst doesn't just crunch numbers, they look beyond the financial statements. As an investor, you should evaluate a company's future income and growth potential based on 3 broad factors. First, economy-wide factors, the overall health of the economy. Things like the unemployment rate, general inflation, and changes in interest rates has a direct impact on individual business performance. Okay, for example, rising interest rates can negatively impact sales in the home improvement industry. Second, industry factors. Certain events like a decline in housing turnover will have a major impact on every competitor within that specific industry, but only a minor impact on companies outside of it. Okay. Third, individual company factors. These are the unique elements not always quantified in the financial reports, such as the quality of the management team or the effectiveness of their products. Okay. You need to assess the quality of a company's balance sheet and the quality of its core offering. Understanding these external and internal factors provides the necessary framework for interpreting the financial data we are about to compute. Alright, our next topic is vital. Before you calculate a single ratio, you need to know what you're looking for. A company's performance is best evaluated by comparing its financial results to the objectives management was trying to achieve. The relationship is direct. Okay, strategy leads to operating decisions, which leads to transactions, and those become the financial statements. Okay. There are 2 fundamental strategies a business can follow. Product differentiation strategy focuses on unique benefits like quality or features, allowing the company to charge higher prices and achieving a higher profit margin. Okay, think of brands like Lululemon, Mercedes, Apple, and Starbucks. Okay, the second is the cost differentiation strategy, where companies operate efficiently to offer lower prices and maximize sales volume. Okay, think of brands like Walmart and McDonald's. Okay, the DuPont model is our key analytical tool here. Okay, as it shows precisely how these strategies drive profitability. Okay, the model breaks down return on equity into 3 components. Okay, if a company pursues the product differentiation strategy, they rely on a high net margin to drive ROE. Okay, if they pursue the cost strategy, they rely on a rapid asset turnover. Okay, understanding the company's strategy tells you which part of the model to prioritize in your analysis. Alright, we've established the overall strategy. Now we look at the analytical methods used to evaluate financial performance. Okay, the most fundamental rule is that financial results cannot be evaluated in isolation. Okay, a company's profit is meaningless unless you develop appropriate comparisons. Financial analysis requires judgment, not just mechanical calculation. Okay, analysts use 2 primary methods for comparison. Okay, on the left we have time series analysis. This involves looking at a single company's performance, like its sales growth for example, over several years. Okay, This line graph visually illustrates the importance of examining trends and identifying progressive deterioration or improvement in performance. On the right, we have comparison with similar companies. Okay, since industry and economy-wide factors affect everyone, comparing a company with another in the same line of business gives better insight into its performance. Okay, the bar chart shown here compares key measures across competitors, and this helps to filter out general market effects. Okay, these two frameworks, looking at a company's past and looking at its peers, are essential for all subsequent ratio analysis. All right, we are transitioning now to the analytical tools that financial professionals use every day, ratio and percentage analysis. At its core, a ratio simply expresses the proportional relationship between two different amounts. This simple act of comparison is what allows for a meaningful analysis. Okay, for example, just knowing a company earned $500,000 in net income isn't enough. But comparing that $500,000 to its $5 million in stockholders' equity tells you that the company achieved a 10% return on its investment. This provides a vital insight into performance that the raw dollar figures simply hide. Okay? Ratios offer flexibility as they can be calculated using numbers all from one statement or by combining numbers across the income statement and balance sheet. However, analysts only compute the ratios that are relevant, ignoring any ratios where the amounts have no natural relationship. Okay, this is the foundation for all the categories we'll cover, starting with component percentages in the next slide. Okay. All right, the first practical tool we'll look at is component percentages. Okay, this method is foundational because it expresses every item on a financial statement as a percentage of a single base amount, which immediately eliminates the problem of a company's size. Okay, look at the tables on the slide. On the income statement on the left, the base is always the net revenue or sales, okay, which is set to 100%. Every expense is shown as a piece of that sales dollar. Okay, for example, this company's cost of sales is 65% of the revenue and its net income is 5% of the revenue. Okay, on the balance sheet on the right, this base is total assets, okay, which is also set to 100%. Okay, here 70% of the company's growth is funded by liabilities and 30% is funded by stockholders' equity. Okay, the real value lies in the analysis. This tool helps us find trends. If the selling, general and administrative expense percentage were to suddenly rise from 20% to 25% over time, that immediately signals that the management is failing to keep costs in line with the level of sales activity. Okay, it allows for easy efficiency comparison with competitors regardless of their scale. All right, we've compared component percentages, which are the start of our analysis. Okay, now we dive into the 5 essential categories of financial ratios that analysts use. Okay, we group these ratios because each answers a distinct fundamental question about a company's health, risk, and performance. Okay, category 1, which is tests of profitability, these measure the overall success and sustainability of a company's income, asking if a company is generating adequate income relative to its investments and sales. Category 2, which is tests of liquidity. Okay, liquidity measures a company's ability to meet its currently maturing debts or short-term obligations, asking, can the company pay its short-term bills? Okay, category 3, tests of solvency. Okay, solvency measures a company's ability to meet its long-term obligations. Okay, this is a long-term survival check, asking if the company can withstand financial stress. Okay, category 4, market tests. Okay, these relate to the company's financial performance to the current market price of its stock, showing how the market values company's return and future potential. Okay, category 5, which is efficiency measures. Okay, these ratios assess how effectively management utilizes assets like inventory and fixed assets to generate maximum sales volume from the resources they control. All right, before we start calculating, we must establish one crucial non-negotiable rule that governs ratio computation. Okay, look at the diagram here. The core issue is time. Okay, the income statement covers the entirety of a period, like year 2 for example, okay, flowing across the timeline. Okay, but the balance sheet is a snapshot taken at a single moment in time, like the 31st of December, okay, on the end of year 1 or the end of year 2. Okay, when a ratio compares an income statement figure from year 2 to a balance sheet figure, using a single static balance sheet number would be inconsistent and potentially inaccurate. Okay, therefore, the rule is the balance sheet amount in the denominator must be expressed as an average of the beginning and ending balances of the period covered by the income statement. Okay, we calculate the average by summing the beginning and ending balances and dividing by 2. Okay, while some analysts may use the ending balance as a shortcut, especially if the change is small, using the average is the standard approach for consistency and accuracy. Okay, always check the methodology when reviewing ratios calculated by others. Alright, we've covered the foundational rules for financial analysis. Now we start diving into the 5 categories of ratios, beginning with category 1, that is tests of profitability. Okay, profitability is the most vital measure of a company's overall success and is absolutely necessary for its survival. Okay, these ratios measure the adequacy of income by comparing it to other key items like sales revenue or the total investment made by owners. We'll cover 6 key profitability ratios starting in the next slide that help us determine if a company is earning an appropriate return for the risk and resources involved. Okay? Alright, our first measure is return on equity or ROE. Okay? This ratio directly relates the income earned to the investment made by the owners, the stockholders. Okay? It reflects the simple fact that investors expect a higher return if they commit more capital. The formula is net income divided by average stockholders' equity. Okay, we use the average equity because net income covers the entire period, making the average balance a more consistent denominator. Okay, ROE is compared to the return for similar companies and to the company's own historical performance to determine if the return is adequate. Okay, our second measure is return on assets or ROA. Okay, this compares income to the total assets used to earn that income, essentially measuring the return on the total investment in the company. Okay, analysts often consider ROA a better measure of management's ability to utilize assets effectively because it's not affected by how these assets are financed, whether with debt or equity. Okay, notice the numerator here. We take net income and add back interest expense net of tax. Okay, why do we do this? Because the denominator, average total assets, includes resources provided by both owners and creditors. Okay, by adding back the interest, we are ensuring the numerator reflects the return available to both groups of investors, giving us a clean look at operating effectiveness. Okay. Alright, building on ROE and ROA, the financial leverage percentage is our third profitability measure. This is an extremely insightful metric because it measures the advantage or disadvantage a company gains from using debt to finance its operations. Okay, the formula is simple. It's return on equity minus return on assets. Okay, we call it positive leverage when the result is positive, meaning ROE is greater than ROA. Okay, this occurs when the company is earning a higher rate of return on its total assets than the after-tax interest rate it's paying on its debt. Okay, the difference, that extra profit, accrues entirely to the benefit of the owners. Okay, positive financial leverage is the primary reason most companies obtain resources from creditors rather than just selling more stock. Okay, they effectively borrow at one rate and invest at a higher rate of return. Okay, if ROE is lower than ROA, the company has negative leverage, meaning the cost of the debt is eroding value for the shareholders. Alright, we are now covering the third set of profitability measures, focusing on earnings per share and the quality of income. First, earnings per share or EPS. This is likely the single most widely watched ratio in the market. Okay, it measures the return on investment based on the number of shares outstanding. While simple to calculate, net income divided by the average shares outstanding, its impact on stock price is huge as it's the primary benchmark for corporate performance. Okay. Next, the quality of income ratio. Analysts are deeply concerned about the quality of earnings because different accounting procedures can be used to report higher income. Okay. This ratio acts as a check. The formula is cash flows from operating activities divided by net income. A ratio higher than 1 indicates high quality earnings, meaning every dollar of reported income is backed by cash. A ratio below 1 suggests lower quality or potentially less reliable earnings. Alright, we are concluding our section on tests of profitability by focusing on our sixth measure, profit margin. Okay. Profit margin measures the percentage of each sales dollar on average that actually represents profit. The formula is straightforward: net income divided by net sales revenue. Okay. A company's profit margin is a key indicator of its operational efficiency. For example, knowing a company generated 5 cents of profit for every dollar of sales is a much better measure of efficiency than looking at raw income figures. Okay. However, you must exercise caution when analyzing this ratio. It's very difficult to compare profit margins across different industries. Why? Because the amount of resources, the total investment needed to earn that income is not considered here. Okay. This leads to the crucial trade-off. A high sales volume can compensate for a low profit margin. For instance, grocery stores have low profit margins but generate a high sales volume from relatively inexpensive stores and inventory. Conversely, a high fashion jewelry store has a very high profit margin but a low sales volume. A larger profit margin isn't always better. What matters is the balance between margin and sales volume. Alright, we've completed our tests of profitability. We've established how successfully the company is earning money. Okay. Now we move to category 2, tests of liquidity. Liquidity refers to a company's ability to meet its current maturing debts. Okay. These tests focus on the relationship between current assets and current liabilities. Okay. The ability to pay these short-term liabilities is crucial. A company, even a profitable one, can fail if it doesn't have sufficient cash on hand to pay its obligations on time. This can lead to losing cash discounts and running the risk of having credit discontinued by vendors. Okay. In this section, we'll cover the core liquidity ratios that assess a company's short-term financial strength, the cash ratio, the quick ratio, and the current ratio. Alright, we begin with the cash ratio. This is the most stringent liquidity test because its numerator includes only cash and cash equivalents, okay, comparing them directly against current liabilities. This tells you if a company can meet its current debts with immediately available funds. Okay. However, while financial safety is good, most analysts believe this ratio shouldn't be too high. Okay. Holding excess cash is usually uneconomical. Okay. Companies should invest cash in productive assets or use it to reduce debt, so a high cash ratio can signal inefficient cash management. Okay. Next is the quick ratio or acid test. Okay. This is the next level of stringency. The numerator uses quick assets, which specifically excludes inventory and prepaid expenses. Why exclude them? Because of the uncertainty regarding the timing of their conversion to cash. Inventory especially can take a long time to sell. Okay. This ratio measures the immediate safety margin available to meet debts using assets that are already cash or can be converted to cash very quickly. Okay. It's considered a better measure than the cash ratio because it's less sensitive to the timing of small cash transactions. Okay. Finally, we have the current ratio. This is the least stringent because its numerator includes all current assets, including inventory and prepaids. Okay. This measures the overall cushion of working capital available to cover short-term debts. Okay. While a ratio of 2:1 is often cited as financially conservative, the optimal level depends entirely on the company's business environment and industry. Okay. For example, a retailer often has a high current ratio because they must carry large inventories, while a company with very stable cash flows, like a utility company, can operate efficiently with a much lower ratio. Okay? Alright, we've covered profitability and liquidity. We now move to category 3, tests of solvency. While liquidity measures a company's ability to meet its short-term debts, solvency measures a company's ability to meet its long-term obligations. Okay? Solvency is essentially a test of a company's financial structure and its ability to survive over the long term, especially under financial stress. Okay? These tests focus on the adequacy of a company's earnings and cash flows to cover fixed obligations like interest and principal repayment. Okay? We will look at 3 crucial ratios here: times interest earned, cash coverage, and debt to equity ratio. Okay? Alright, our first measure is the times interest earned ratio. Okay? This is a safety ratio that measures the amount of income generated to cover the fixed interest payment obligation. The higher the ratio, the greater the margin of protection for creditors. Okay? Notice the numerator, we add back interest expense and income tax expense to net income. This calculates the income available before these mandatory fixed charges were subtracted. Okay? Our second measure is the cash coverage ratio. Some analysts argue that the times interest earned ratio is flawed because interest is paid with cash, not with net income. Okay? The cash coverage ratio solves this by comparing the cash flow from operating activities before interest and taxes are paid to the actual cash paid for interest. This ratio gives a stronger cash-based assessment of a company's ability to service its debt. Alright, we are wrapping up our tests of solvency with the debt to equity ratio. This ratio is a fundamental check on a company's financial structure, showing how much debt it uses relative to the funds provided by its owners. The formula is simple: total liabilities divided by stockholders' equity. This ratio is essential because it highlights the risk-return trade-off. Okay? Debt is riskier than equity because interest payments are legally fixed and enforceable even if the company is unprofitable. Okay? Equity capital, where dividends are discretionary, is much less risky. However, most companies obtain a significant amount of resources from debt because of the benefits of financial leverage and the tax deductibility of interest expense. A high ratio means higher risk but also higher potential returns if management invests effectively. Okay? This ratio is a key part of any company evaluation because it reveals the balance management has struck between higher returns and higher risk. Alright, we've covered the internal financial health of a company with profitability, liquidity, and solvency. Okay? We now move to category 4, which is market tests. Okay? These ratios are unique because they relate the company's financial performance, specifically its earnings, to the current market price of its stock. They measure the market worth of a share of stock and reflect the stock market's collective assessment of the company's future performance and growth potential. Okay, we'll cover the 2 most popular market tests here: the price to earnings ratio or PE ratio and the dividend yield ratio. Alright, the first market test is the price earnings ratio, or more commonly known as PE ratio. Okay, this is a measure that compares the current market price of the stock to the earnings per share. It reflects the stock market's assessment of a company's future performance. Okay, a high PE ratio suggests that the market expects rapid earnings growth. A company that expects to increase its earnings in the future is generally worth more. Okay. Second is the dividend yield ratio. This ratio measures the return provided by dividend income relative to the stock's market price. Okay. Investors who buy stock expect 2 types of returns. Okay. Dividend income and also price appreciation. Growth stocks, where investors expect a large increase in the share price, often have a low dividend yield. Conversely, stocks with low growth potential often offer a much higher dividend yield to attract investors seeking current income. Alright, we've covered profitability, liquidity, solvency. and also market performance. Okay, now we introduce our final set of ratios, which is category 5, efficiency measures, which we also call turnover ratios. Okay, this category directly measures management's operational competence. It asks the question, is the company generating maximum sales volume from the resources they control? Okay, we will cover critical ratios here that focus on how well assets are used. Companies that can quickly turn assets into cash have good liquidity and do not needlessly tie up funds in unproductive assets. Alright, we are now covering the first ratio in our final category, efficiency measures, which is the receivable turnover ratio. This ratio is important because accounts receivable are closely related to both liquidity and operating efficiency. A company that can quickly collect cash does not needlessly tie up funds in unproductive assets. Okay, the formula divides net credit sales by the average net receivables. Okay, a high turnover ratio suggests that a company is effective in its credit granting and collection activities. Conversely, a low ratio suggests problems with credit risk or collection efforts. Okay, we then convert this ratio into a time basis, the average age of receivables or days to collect or days sales outstanding, DSO. Okay, this tells us the average number of days the company waits to get paid. Okay, keep in mind the caution here, analysts must evaluate the results based on their understanding of the business. Okay, for example, retailers who use total sales as a proxy for credit sales can lead to a meaningless ratio since most credit sales use bank credit cards, meaning the cash is collected almost immediately from the credit card company. Okay. Alright, we are continuing our efficiency analysis with the inventory turnover ratio. Like receivable turnover, this is a measure of both liquidity and operating efficiency. The formula divides cost of goods sold by average inventory. Since a company realizes profit every time inventory is sold, an increase in this ratio is generally favorable, right? However, caution is needed. A ratio that is too high can signal that sales were lost because the company was out of stock. Okay, the cost of a lost sale can be high, potentially losing the customer's future business. We then convert this ratio into the time measure, average days supply in inventory or days inventory outstanding or DIO. Okay, this tells us how many days on average the inventory sits on the shelf. Okay, this time measure is critical for efficiency. For instance, the food industry has a high turnover because inventory deteriorates quickly, while the automobile industry has low turnover. Effective inventory management, as measured by a healthy turnover, means the company ties up less money and operates more efficiently. Alright, we are now going to synthesize the time measures we've been discussing to understand the complete operating cycle. Okay, the operating cycle measures the time it takes for a company to go from purchasing inventory to selling it and finally collecting the cash from the customer. Okay, analysts are keenly interested in this because it helps them evaluate a company's cash needs and management efficiency. Look at this diagram. The cycle starts when you purchase inventory and ends when you receive cash from the customer. Okay, the top half of the diagram shows the traditional operating cycle measured as days inventory outstanding plus days sales outstanding or the average age of receivables. Okay, the DIO, which is the days supply of inventory, okay, is the time the inventory sits on the shelf. Okay, the DSO, which is the days supply of receivables, is the time until the cash is collected. However, the key is the cash conversion cycle. Okay, this is the time cash is actually tied up in the business. Okay, this period starts when the company pays the supplier, okay, which is DPO or days payable outstanding, and ends when the company receives the cash. Okay, the ultimate goal is to minimize this time between paying vendors and collecting from our customers. Okay, minimizing the cash conversion cycle frees up cash for other productive purposes, demonstrating top management efficiency. Alright, we are continuing our efficiency analysis with the fixed asset turnover ratio. This ratio measures management's ability to utilize its investment in long-term tangible assets like equipment, buildings to generate sales. Okay. It's calculated by dividing net sales revenue by the average net fixed assets. Okay. We use average net fixed assets because fixed assets are a balance sheet account requiring consistency with the income statement. A high ratio is favorable, indicating the company has a competitive advantage in utilizing its fixed assets to earn revenue. The asset turnover ratio is a more broader measure. Okay, it compares net sales to average total assets. Okay, analysts often prefer this ratio when analyzing companies like retailers who hold large amounts of inventory and accounts receivable. Okay, both turnover ratios are key indicators of operating efficiency. As the DuPont model shows, if you remember, high asset turnover is essential for companies that follow a low margin cost differentiation strategy. We've covered all 17 ratios across the 5 major categories. Okay. This slide summarizes the interpretive direction for every ratio we studied. Look at the column titled Interpretation. Most ratios fall under the higher the better category, right? This generally applies to measures of return like ROE and ROA, solvency coverage like times interest earned, and efficiency like fixed asset turnover, right? The primary ratio that is generally lower the better is the debt to equity ratio, as a low ratio signals less risk from external debt financing. Okay. Crucially, focus on the nuances. Measures like the cash ratio and turnover ratios should be high, but not too high. A very high cash ratio can be bad because it means the company is holding too much idle cash, which is uneconomical. Okay. A very high inventory turnover ratio can be detrimental, suggesting that the company is running out of stock and losing sales. Similarly, the current ratio's ideal level is context dependent. Its function is to provide a working capital cushion, and the optimal level changes based on the industry and predictability of cash flows. The dividend yield ratio is also context dependent. A high yield appeals to investors seeking current income, while a low yield is common for growth stocks where investors expect high price appreciation. Use this table to build your analytical judgment, always asking what is the company's strategy and what is this ratio telling me about its execution. Alright, I promise this is our final analysis slide addressing the necessary cautions and limitations that all professional analysts must keep in mind. Ratios are a powerful tool, but they are not the final word. Okay. First, remember that ratios are not standardized. Except for earnings per share, analysts often compute ratios differently. You must always determine the exact computational approach used before relying on a ratio provided by another source. Second, comparisons are tricky. Ratios are only meaningful when comparing firms that are comparable in terms of their industry, size, operations, and accounting policies. An optimal ratio for one business may be inappropriate for another. Okay. Ratios are based on aggregated data, and this aggregation can obscure underlying problems. For instance, a high current ratio for a consolidated parent company might hide a severe liquidity problem in one of its subsidiaries. Okay. The averaging effect of the consolidation obscures the risk. Companies rarely use the exact same accounting policies. Differences like using LIFO versus FIFO or accelerated versus straight line depreciation can significantly change reported profitability. An analyst must understand these effects to interpret results correctly and make valid comparisons. Ultimately, financial analysis is a judgmental process. You must look beyond the reports as vital information about a company's strategy, management quality, and competitive standing, like checking pricing at a competitor store, is often not contained in the annual report. Alright, we have reached the end of session 12 and the conclusion of our course on financial accounting. This final session brought everything together, right? Remember that financial analysis starts with context, understanding a company's strategy and the economic factors affecting it, as this dictates which ratios are most important. We learned that comprehensive analysis relies on examining 5 core categories of ratios to assess risk and return. Most importantly, remember the lesson that analysis is part art and part science. Your final judgment must go beyond the computed numbers. You must account for differences in accounting policies and ensure your comparisons are valid between similar companies. Thank you for completing this comprehensive journey through financial accounting. You've successfully mastered the preparation and analysis of all major financial statements. And finally, if you want to expand your knowledge of accounting, finance, economics, math, statistics, and other related areas, I invite you to subscribe to my channel. You can also visit my website, which is jofessa.com, for additional resources and materials. Thank you again for your time, and I hope to see you in future videos or on my website. Cheers!